Most traders think markets move because of news, but the reality is, by the time the news is released, the market has already moved. And if you don't understand this, you're not trading the market, you're reacting to it. Now, at the beginning, most traders believe something very intuitive. News comes out, the market reacts, and price moves. But in real financial markets, that sequence is incomplete because markets don't wait for information, they anticipate it. They are forward-looking systems, constantly pricing what participants expect to happen next. This is what traders refer to as priced in. Before a major event happens, like inflation data, interest rate decisions, or unemployment reports, institutions, funds, and participants are already positioning themselves. That positioning moves the price before the event even happens. So when the news is finally released, it's not new information, it's confirmation or deviation from expectations. The market doesn't move because of the news, and this is where most traders get confused. All right, let's break it down. If a data release comes exactly as expected, then the markets may barely move. Why? Because that outcome was already anticipated. Positions were already built around that scenario. But if the data is different from expectations, that's when the real movement happens. Because now the market has to reprice quickly. Let's say the market expects inflation to come in high. Okay, participants have already adjusted their positions for that scenario. Now, imagine the data is released, okay? If inflation is high, as expected, there's a minimal reaction. Now, if inflation is lower than expected, there's a strong movement. And not because the number itself matters, but because it changes expectations going forward. This is also why markets sometimes behave in ways that seem confusing. You might see positive news, but price drops. Negative news, but price rises. And it feels wrong. But in reality, the market had already priced in a different scenario. So what you're seeing is not the reaction to the news, it's the reaction to the surprise. Here's what really happens behind the scenes. Expectations are formed. Market participants position themselves. Price adjusts before the event. The news is released. The market compares expectation versus reality. The price rapidly reprices if needed. And this entire process can happen in seconds. For traders, this changes everything. Because you're not trading the news itself, you're trading how the market interprets the news. And that's what creates sudden volatility, rapid price movements, spread expansion, and execution differences, especially in assets like the US 100 or major currency pairs in gold. Now, once you understand this, you stop reacting to headlines and you start observing how the market is positioning before events, whether expectations are already extreme and where liquidity might be resting. But that's where the real opportunity is. Professional traders don't wait for the news to tell them what to do. Markets don't move because something happened. They move because something happened that wasn't expected. And once you understand that, you stop chasing the market and start reading it. The market is driven by expectations. Understanding them changes how you interpret price.